School of Management Studies IGNOU presents an audiobook on the course MMPC 004 Accounting for Managers for MBA program. Block 3 Application of Cost Accounting Unit 11 Variance Analysis.
This unit aims at acquainting you with the ways in which the management can monitor and guide the operations of a business to meet the desired goals, particularly in respect of cost and sales, and also in helping you in identifying the factors responsible for deviation of actual performance from the standard performance and in taking such remedial measures as may be necessary. Introduction. Profit making is the prime objective of business enterprise. Profit depends basically on two factors, cost and sales. In order to achieve better performance, it is necessary that you lay down your targets in respect of both of them. Your objective should be to maximize the sales and minimize the cost. This will result in maximization of the profits and, in the long run, the wealth of the firm. Variance analysis is intimately connected with budgetary control, which helps the management in number 1. Planning future activities, number 2. Comparing actual performance with the budgeted performance, number 3. Identifying the variances as to their causes, and number 4, ensuring that remedial measures are taken at an appropriate time. Meaning of variance. Variance is the difference between budgeted and the actual level of activity. Since, as explained earlier, the profitability of a business depends both on cost and sales. It is important to analyze both cost and sales variance. Cost variance is the difference between what should have been the cost, popularly termed as standard cost, and what has been the cost, that is, actual cost. If the actual cost are less than the standard cost, the variance is termed as favorable. However, if the actual cost is more than the standard cost, variance is termed as adverse or unfavorable. Sales variance is the difference between what should have been the sales, popularly termed as budgeted sales, and what have been the sales, that is, the actual sales. If the actual sales amount is more than the budgeted sales, the variance is termed as favorable. However, if the actual sales amount is less than the budgeted sales, the variance is termed as adverse or unfavorable. Thus, variances may be classified into two categories. Number 1, cost variances, and number 2, sales variances. In the following sections, we will explain both types of variances in detail. Cost variances. Cost variances include direct material cost variance, direct labor cost variance, and overhead cost variance. Direct expenses constitute an insignificant portion of the total cost of the product. Hence, direct expense variance is generally not calculated. Suppose it is desired to calculate the direct expense variance. In that case, it can be computed in the same way as the variable overhead variance is calculated. Since in most cases, direct expenses are variable. In the course of the discussion in this unit, you will find that abbreviations for different variances have been used. For your facility, we are explaining you all such abbreviations with full names of the variances. DMCV. It stands for Direct Material Cost Variance. DMPV. It stands for Direct Material Price Variance. DLCV. It stands for Direct Labor Cost Variance. DLRV. It stands for Direct Labor Rate Variance. DLEV. It stands for Direct Labor Efficiency. Variance OCV. It stands for Overhead Cost Variance. VOCV. It stands for Variable Overhead Cost Variance. FOCV. It stands for Fixed Overhead Cost Variance. FOEXPV. It stands for Fixed Overhead Expenditure Variance. FOVV. It stands for Fixed Overhead Volume Variance. SVV. It stands for Sales Value Variance. SPV. It stands for Sales Price Variance. SVOLV. It stands for Sales Volume Variance. Direct material variances. Three types of direct material variances are explained here in this unit. The first one is direct material cost variance, which is DMCV, and it is equal to the difference between the standard cost of direct materials specified for the output achieved and the actual cost of direct materials used. The standard cost of materials is computed by multiplying the standard price with the standard quantity for actual output, and the actual cost is computed by multiplying the actual price with the actual quantity. Formula for computation. Direct material cost variance or DMCV equals to cost for total actual cost or actual output. Hence, the formula will be standard price into standard quantity for actual output minus actual price into actual quantity. If the actual cost is more than the standard cost, it will result in an adverse variance and vice versa. If standard output and actual output are different, the variances are to be calculated keeping in view the actual output. The information regarding standard output, which is different from standard quantity, is thus not relevant. The material cost variance may arise either on account of change in price, quantity, or both. Thus, material cost variance may be further analyzed as material price variance and material usage variance. Direct material price variance. DMPV or direct material price variance is concerned with that portion of the direct material cost variance which is due to the difference between the standard price specified and the actual price paid. Hence, formula for computation will be direct material price variance or DMPV equals to actual quantity into standard price minus actual price. If the actual price is more than the standard price, the variance would be adverse, and in case the standard price is more than the actual price, it would result in a favorable variance. The reasons for price variance may be: number 1, fluctuations in market prices. Number 2, market trends may be bullish or bearish. Number 3, increase or decrease in prices on account of agreement between various suppliers or on account of government intervention. Number 4, buying efficiency or inefficiency. Number 5, high or low cost of transportation and carriage of goods. Number 6, changes in or laxity in pursuing purchase policy. Number 7, Superior or inferior, that is, non-standard material might have been purchased. Number 8. Purchases might have been effected in small quantities instead of in bulk or vice versa. Number 9. Substitute and cheaper materials might have been used. Number 10. Emergency purchase, that is placing rush orders for immediate delivery at the prevalent price. Number 11. Fraud in purchases and loss of discounts. And number 12. Incorrect setting of standards. Some of the facts may be controlled by the management if care or proper control is exercised, while others may be beyond the control of management. If the factors are controllable, the buying department is usually answerable for unfavorable variations. Direct material usage or quantity variance. DMUV is that portion of direct material cost variance which is due to the difference between the standard quantity specified for the output achieved and the actual quantity used. Hence, the formula for computation will be direct material usage variance or DMUV equals to standard quantity for actual output minus actual quantity into standard rate. The actual quantity, if more than the standard quantity, would cause an unfavorable variance and vice versa. The reason for direct material usage variance may be number 1. Inefficiency, lack of skill or faulty workmanship resulting in more consumption of raw materials. Number 2. Lack of proper upkeep and maintenance of plant and equipment and frequent breakdown during production process leading to wastage of material. Number 3. Non-consideration of product design and method of processing etc. while fixing standards. Number 4. Incorrect processing of materials resulting in wastages. Number 5. Non-recording of returns of material to stock or stores or intertransfers from one job to another. Number 6. Improper inspection and supervision of workmen resulting in adverse quantity variance due to careless handling and processing. Number 7. Too strict supervision or inspection resulting in excessive rejections of materials. Number 8. Substitution of specified materials with unspecified materials causing greater consumption of the latter. Price variance could be favorable because unspecified material is likely to be cheaper. Number 9. Incorrect setting of standards leading to variations. And number 10. Excessive wastage, scrap, spoilage, shrinkage, leakage, etc. causing an adverse usage variance. Direct labor variances. The deviations in cost of direct labor may occur because of two main factors. Number 1. Difference in actual rates and standard rates of labor. And number 2. The variation in actual time taken by workers and the standard item prescribed for performing a job or an operation. Labor variances are very much similar to material variances and they can be very easily calculated by applying the same techniques as used in calculating material variances. The students can work out the various formulae for direct labor variances by simply putting the word time in place of quantity in the formula meant for direct material variances. The various labor variances may be. We will explain you the various labor variances. It is the difference between the standard direct wages specified for the activity achieved and the actual direct wages paid. Hence, the formula for computation will be direct labor cost variance equals to standard cost for actual output minus actual cost, or direct labor cost variance equals to standard rate into standard time for actual output minus actual rate into actual time. The direct labor cost variance may arise on account of differences in either rate of wages or time. Thus, it may be further analyzed as number 1, rate variance, and number 2, time or efficiency variance. Direct labor wages rate variance. It is that portion of direct labor wages variance which is due to the difference between the standard or specified rate of pay and the actual rate paid. Hence, the formula for computation will be direct labor rate variance or DLRV equals to actual time into standard rate minus actual rate. If the actual rate is higher than the standard rate, it shall result in an unfavorable variance and vice versa. The reasons for direct labor rate variance may be number 1, deployment of more efficient and skilled workers giving rise to higher payment. Number 2, higher payment due to shortage of availability of labor. Number 3, lesser payment due to abundant availability of labor or high competition among them for employment. Number 4, employment of unskilled laborers causing lower actual rates of pay. Number 5, extra shift allowance to workers or overtime allowance for work done after normal hours leading to higher wages. Number 6, higher piece rates for better quality production. Number 7, change in the system of wage payment from time wages to piece wages or vice versa, introduction or withdrawal or incentive or bonus schemes, etc. Number 8, change in wage rates probably due to a revised agreement with labor union. And number 9, higher rates during seasonal or emergency operations. Direct labor efficiency time variance. It is that portion of the direct labor variance which is due to the difference between the standard labor hours specified for the activity achieved and the actual labor hours expended. Hence, the formula for computation will be labor efficiency variance equals to standard rates into standard time minus actual time for actual output. Labor efficiency variance may be caused due to number 1, defective or bad materials. Number 2, breakdown of plant and machinery. Number 3, failure of power. Number 4, efficient working by the laborers and fuller utilization of time due to incentives given. Number 5, loss of time due to delayed instructions from management or delay in receipt of raw materials. Number 6, alteration in the method of production. Number 7, more time taken by workers due to lack of proper supervision and control by management, making the workers lazy and inefficient. Number 8, too rigid a system of inspection and control. Number 9, poor working conditions. Number 10, lower productivity due to lack of training, ability or experience on the part of workers. And number 11, labor turnover or changeover of workers from one operation or process or department to another. Overhead variances. The term overhead includes indirect material, indirect labor, and indirect expenses. Overheads may relate to factory, office, or selling and distribution departments. However, for the purpose of variance analysis, we can broadly divide the overhead cost variance into two categories. Number 1, variable overhead cost variance or VOCV, and number 2, fixed overhead cost variance or FOCV. Overhead cost variance or OCV. It is the difference between the standard overheads for actual output, that is, recovered overheads, and actual overheads. It is the total of both fixed and variable overhead variances. Hence, overhead cost variance equals to recovered overheads minus actual overheads. Variable overhead cost variance or VOCV. It is the difference between standard variable overheads for actual output or recovered variable overheads and actual variable overheads. Hence, VOCV equals to recovered variable overheads minus actual variable overheads. Causes of variance. This variance may be due to advance payment of expenses or outstanding expenses or payment of past outstanding expenses during this period or on account of certain abnormal expenses incurred such as repairs of machinery due to breakdown, expenses due to spoilage or defective workmanship or excessive overtime work, etc. Fixed overhead cost variance or FOCV. It is the difference between standard fixed overheads for actual output or recovered overheads and actual fixed overheads. Hence, FOCV equals to recovered fixed overheads minus actual fixed overheads. Causes of variance. Difference between actual and recovered. Fixed overheads may be on account of number 1. A higher or lower amount of fixed overheads compared to budgeted fixed overheads might have been incurred for the same production during the same period. Number 2. The same amount of fixed overheads might have been incurred for a high or lower production than the budgeted production during the same period. Classification of fixed overhead variance. Fixed overhead variance may be classified as fixed overhead expenditure variance or FOEXPV and fixed overhead volume variance or FOVV. Fixed overhead expenditure or budget or controllable variance, that is FOEXPV. This variance is due to the difference between budgeted fixed overheads and the actual fixed overheads incurred. Hence, FOEXPV equals to budgeted fixed overheads minus actual fixed overheads. Fixed overhead volume variance or FOVV. This variance arises because of the difference between standard and actual output, resulting in under and over recovery of fixed overheads. It is therefore the difference between overheads absorbed on actual output or recovered overheads and those on budgeted output or budgeted overheads. Hence, FOVV equals to recovered fixed overheads minus budgeted fixed overheads. Sales variances. Sales are affected by two factors. Number 1, the selling price, and number 2, the quantum of sales. The variations in the standards set and actual for the purpose may be mainly due to change in market trends. Usually, if the selling price increases, the volume of sales will be lower than the standard. It may result in a favorable variance as to price or unfavorable variance as to quantity. It is to be borne in mind that higher price here is to be viewed as a favorable, that is, higher price paid for the material. It will be recalled causes an adverse variance. And lower volume of sales is to be viewed as unfavorable. In case of materials, it is the other way round, that is, lower usage of materials than the standard causes a favorable variance. It is well known that demand and supply position in the market decide the quantity of sales and the selling price. The variations may be on account of control lapse as well as non-controllable factors. Changes in market conditions and demand by customers are, of course, beyond the control of management. However, certain factors like high prices are controllable and an effort should be made to check adverse variations due to these factors. Sales value variance includes sales price variance and sales volume variance. Sales value variance. The difference between budgeted sales and actual sales results in sales value variance. The formula is sales value variance equals to budgeted sales minus actual sales. If actual sales are more than the budgeted sales, a favorable variance would be reported and vice versa. The difference in value may be on account of a difference in price or volume of sales, which is therefore analyzed further. Sales price variance. It can be calculated like material price variance. It is on account of the difference in actual selling price and the standard selling price for actual quantity of sales. The formula is actual quantities sold into standard price minus actual price, or price variance equals to standard sales minus actual sales. Sales volume variance. It can be calculated like material usage variance. Budgeted sales may be different from standard sales. In other words, budgeted quantity of sales at the standard price may vary from the actual quantity of sales at standard prices. Thus, the variance is a result of difference in budgeted and actual quantities of goods sold. The formula is standard price into budgeted quantity minus actual quantity, or volume variance equals to budgeted sales minus standard sales. If the standard sales are more than the budgeted sales, it would cause a favorable variance and vice versa. The total of price and volume variances would be equal to sales value variance. Control of variances. After the variance have been computed and analyzed, the next logical step for the management is to trace the responsibility for the variances to particular individuals or departments. The management or cost accountant may be required to prepare the necessary report for this purpose. The report submitted to the management should clearly indicate where action is required. Based on this report, the management will try to identify the specific individuals for adverse controllable variances which, being within their control, could have been avoided. It was earlier mentioned that certain factors such as changes in market conditions, demand and supply position, etc., are beyond the control of managers. Hence, action to pinpoint the responsibility of such uncontrollable variances is not called for. It may be noted that variance analysis would not help in achieving the desired objective of minimizing cost unless managerial action is prompt and in the right direction. The direction, of course, shall be indicated by the analysis of variances, but it is the executive side which would be responsible for taking immediate action, exercising proper control, having a close watch over operations, etc., so that economies may be affected by inefficiencies minimized and performance improved. A continuous and rigorous effort in cost control would help the management achieve the goal of standard costing. Variance reporting. As stated so far, the deviations along with their causes should be reported to the management regularly and at the opportune time so that corrective action may be taken immediately. The person or department may be held responsible for any adverse variations after duly accounting for it. The information about the profit earned by the business is presented through a simple profit and loss account where a system of historical costing is prevalent. However, when a system of standard costing is in operation, the information about the standards, the actual and the variances along with their causes should be depicted through a statement so that the management may be able to take quick action in respect of any inefficiencies thus revealed. The statement draws a reconciliation between the budgeted profit or standard profit and actual profit. The profit statement submitted to the management should contain notes to explain the causes of the variances. Since the rule of management by exception is followed, greater attention in the reported statement is drawn towards the adverse variances, that is, the reasons for the failure or poor performance are highlighted in particular, along with comments on general overall performance. Now let's summarize the unit. The profitability of a business enterprise depends basically on two factors: cost and sales. The efforts of the management should be to minimize the cost without compromising on the quality and pushing up the sales of the products. This requires proper monitoring of both cost and sales performance. Targets have to be fixed and the actual results should be compared with the predetermined targets and variances found out. Variance refers to the difference between the standard or budgeted performance and actual performance. Variance analysis is mainly concerned with ascertaining the quantum of variances and the analysis of the causes responsible for such variances. In the case of cost variance, if the actual cost is more than the standard cost, it is termed as an adverse variance. While in the case of sales variances, if the actual amount of sales is more than the budgeted sales, it is termed as a favorable variance. Variance reports have to be submitted to the management from time to time. These reports contain details regarding the budgeted or standard performance, actual performance, the quantum of variances, and the departments or executives responsible for adverse variances. On the basis of these reports, the management can fix the responsibilities on the executives for controllable variances and takes necessary steps so that such variances do not occur in future. For variances caused by uncontrollable factors, management should try its best to minimize the effect of such factors or revise budgeted or standard performance if necessary.
We were listening to the audiobook by the School of Management Studies IGNOU for MBA program course code MMPC 004 Accounting for Managers. Course Coordinator Professor Kamal Bagrecha, School of Management Studies IGNOU. Voiceover by Harpreet Kaur. Edited by Ashok Sharma. Program assisted by Tarannum Jahan and Jagbandhu Jana. Program produced by Dr. Manoj Kumar Singh. This program was brought to you by Electronic Media Production Center of Indira Gandhi National Open University.